Well, good afternoon, everyone. Thank you for joining us today. Afternoon here on the East Coast, or maybe still morning, depending where you're coming from. Today, we have a list of speakers to come to you with some topics you've probably heard us talk about individually before. A lot of the things, again, that have happened over the last 18 months. But today, what we hope to do is really tie all of this together for you into one coordinated effort so that you can get the most benefit out of all these different strategies. Before we start, I'm Tom Mao. I serve as the Director of Strategic Tax Services here at Stanbaugh Mass. I'm merely going to be your host today. We have a list of other experts here I'm going to introduce in a minute that are going to give you all the good information. But before we do that, we do have a couple of housekeeping items that we need to address, as we always do in our webinars. The first is, if you would like to change the view, viewing the speakers and the material, you can do that by just going into your GoToWebinar screen viewer and customize by using the drop-down arrows there. We will be taking questions, but please use the questions box rather than the chat panel. We do not monitor the chat panel during the webinar, so please enter your questions in the questions panel. We will try to answer as many as we can behind the scenes as we go through today's session, but those that we don't get to, we will be answering all of those, and as always, we will send an email out to all the participants afterwards with the answers to all the questions so that you'll have the opportunity to be able to see all of those results. If you're having any problems with the audio, we do recommend, because of bandwidth, that you use the dial-in that was provided of the phone, but if that's not working, you can certainly use the computer audio as well. We will be having some poll questions today. We're required to do that for those that need continuing education. So please do answer all of those poll questions. We need to get to a certain percentage for it to count. So please try to answer those promptly when they come up. There will also be a survey at the end, and we ask you to complete that as well and indicate on there that you do need CPE. We do use a third-party provider for the CPE. The name is SimpleCert, so you will get an email from SimpleCert a little bit later with your certificate. But the survey is important to us as well because it gives us a lot of good feedback on what you thought of today's webinar and what topics you'd like to hear in the future. So we really appreciate if you do fill that out for us. Also, you will have the opportunity, the slides are already available there under the downloads or the handouts section in the GoToWebinar panel. You can download them there, or we will be sending them out to all the participants after the session along with a copy of the recording. So even if you don't get a chance to drop those down and download those during the session, you will get those. So with that, let's go ahead and get started. As I said, it's been a year and a half, as you all know, like no other, since COVID-19 kind of reared its ugly head back in March of 2020. There have been so many different legislative changes that have occurred, and it's kind of been a whirlwind keeping up with them. They've changed from time to time. I think the pace of change has slowed now, but the thing that we're seeing is now the states are starting to catch up with their interpretations. Everybody's trying to take advantage as best they can of all of these different scenarios. And sometimes what people overlook is that maximizing one item, say it's PPP loan forgiveness, can have some unintended consequences on something else that you deal with, maybe your certified overhead rate. So today we're going to not only give you a little bit of a review on each of these areas, but really most importantly, discuss how they all interact with each other and how to best plan for them. Because I think you're going to hear the theme of our discussion today is that the best approach is really a coordinated one. So just taking a look at what we're going to talk about today and who's going to talk about it, as soon as I get done with my introduction here, I'm going to turn it over to Kelly Chambers. And a lot of you have already heard Kelly speak. Kelly is our resident guru on the Employee Retention Tax Credit. And boy, the Employee Retention Tax Credit, I think, has become a bigger deal than any of us initially thought it would be. Kelly has helped firms all over the U.S. save literally millions upon millions of dollars, and she's going to talk about that first. Then Steve Snyder is going to follow, and he's going to talk about two areas. One, again, is what we've been talking about for a very long time, the Paycheck Protection Program loan forgiveness, and then how both the ERTC and the PPP forgiveness can have an impact on your overhead rate. And certainly the big cautions there is to not, have an unintended consequence on that overhead rate when you're trying to concentrate on maximizing the other two items. Then Kelly Morningstar is going to jump in. She's going to talk about the research and development tax credit. And those of you that know us here at Stanbaugh Ness know that we think very highly of the R&D credit. Kelly leads a practice where we do well in excess of 100 studies for firms on a repeat basis every year. But starting in 2021, these provisions are even going to have some impact on R&D. So Kelly's going to tell you about that. And then we certainly can't neglect the impact on state taxes, local taxes. Our state and local director, Karen Poist, is going to talk about that impact and also a couple other things that are on the horizon on the state scene that you shouldn't overlook. And then finally, all of our boss, Jen Nelson, who is our managing director of our entire tax practice, is going to talk about how we pull all this together and how you can get the best bang for your buck in all of these provisions without having a nasty surprise somewhere along the line. And then we'll wrap it up, hopefully, and be all done with this by 3 o'clock, or 3 o'clock here on the East Coast. So with that, I'm going to kick it over to Kelly, who's going to jump into the ERTC. And to start it off, Kelly has our first poll question for us. So Kelly, take it away.
Hi, and thank everybody for joining us today for our webinar. So we're going to start this off with asking, have you considered the benefits of the employee tax retention credit for your firm? This is something that will help us to gauge who our audience is, and we'll give you just a minute or so to answer the question. Once we get to about 70 or 80%, we will pull the question down and look at what the responses were from everybody. So we'll give you just another couple of seconds here. Hopefully most of you have heard about the credit before. If you haven't, you certainly are going to know a little bit more information here shortly. And it looks like we are at, well, it looks like almost everybody answered. Okay, so most people, looks like, have actually considered this credit for themselves. So that is wonderful news. Looks like about 28% have not. So maybe we'll find out here a little later if that's because they weren't aware of the credit or if it was because they just didn't feel that they qualified. So we can move on to the next slide. Okay, so what is the Employer Retention Tax Credit? Well, this was enacted back in March of 2020 with the initial CARES Act. At that time, if you got PPP funds, you weren't entitled to take this credit. So there were lots of employers who weren't eligible and just kind of put this credit to the side and didn't really think about it. Well, then come December of 2020, when they updated the CARES Act and they made it retroactive for all the way back to March of 2020 through December of 2020. And you were even allowed to take this if you got a PPP loan. Then forward to March of 2021, when they put the American Rescue Plan into place, and they actually made this available for all of 2021 as well. So now this credit is available for March 13th of 2020 through December 31st of 2021, even if you got the PPP loan. So what's the big deal about this credit? Well, if you look at the rules for 2020, you're allowed to take a maximum credit of $5,000 per employee per year. But for 2021, they greatly enhanced it, and you can actually take a maximum credit of $7,000 per employee per quarter for 2021, which means it jumped from just $5,000 in 2020 to you could potentially get up to $28,000 for the entire year of 2021 per employee. So that's a pretty big deal. So here's an example. If you have 10 employees, and in 2020 you qualified for the credit, you could get a potential $50,000. That's the $5,000 max per employee times the 10 employees. But for 2021, those same 10 employees, if you would happen to qualify for all 4 quarters, you could get a potential of $280,000. Same 10 employees times $7,000 each times the 4 quarters. So that's pretty powerful. So we have to look at the tax impact of this credit. This isn't free like the PPP. With the PPP funds, you didn't have to pick it up on a tax return. It wasn't considered income. But with the ERTC, you actually have to add the credit back to your wage number and reduce your wage expense on your income tax return. This also requires you to reduce your qualified business income deduction wages, which will reduce the amount of the deduction you're allowed to get for the QBI. For 2021, this actually will impact the wages that you're allowed to take for the R&D credit. So overall, what happens is your taxable income is actually increased because you reduced an expense. Even though they say this isn't taxable, it in essence makes it a taxable event. In any case, I'd still want to take 70% and pay 30% in tax in order to get this. So it's definitely worthwhile doing. Next slide, please. Okay, so who qualifies for the ERTC? Any business that has employees potentially will qualify for this credit. If you were fully or partially shut down due to government orders from a government authority that was related to COVID. For 2020, you could also qualify if your gross receipts were less than 50% of any quarter in 2019 compared to 2020 for the same quarter, same period. For 2021, you can do this, you can get the credit if your gross receipts were less than 80% of that same quarter in 2019. So basically saying that you had a reduction of 20% of more of your gross receipts one quarter compared to the other quarter. Next slide, please. So there's some special considerations that you need to take when you're looking at the ERTC. For the PPP-1 and PPP-2, there are interactions. You can't use the exact same wages to take the credit for the ERTC and for the PPP. We are able to allocate the wages between them, and for most of the time, we are able to actually get PPP forgiveness in addition to getting the ERTC as long as you're strategic about what wages you use. There is some wage eligibility requirements. You have to look at the number of full-time employees to be able to determine what wages you're allowed to use. If you have over 100 employees for 2020, then you're only allowed to use wages that you pay people to stay home. If you're under that 100 employees, then you can take everyone's wages. That number actually jumps to 500 when you're looking at the 2021 rules. Nice benefit is you're able to use health insurance in order to maximize the wages. For this credit, they actually count as if they were wages themselves. There's a limitation. If you have a family member that works for your business and you are greater than 50% shareholder, then the family members are not allowed to take the credit. There's some aggregation rules that you need to consider as well. If there's any kind of related ownership, so if you own more than one entity, then you need to look at whether or not you have to aggregate, which would mean you would aggregate your wage numbers. If you have employees in multiple entities, you'd aggregate the number of employees to determine if you're a large or small employer, and then you would also aggregate your revenue to determine whether or not you fell underneath the limits. And in addition to not being able to use the same wages for ERTC and PPP, you also cannot use the same wages to qualify for the FFCAR, which is the COVID pay, the sick pay or expanded family medical leave, or the worker opportunity tax credit. So let's do an example. They actually have something in here called a look back, which allows you to look at your prior quarter to determine whether or not you're eligible for the current quarter. Now that sounds a little confusing, so we have an example here. For 2020, if your fourth quarter revenue is under the limit of the 80% for 2021, you actually can use that to qualify for your first quarter 2021. I know it sounds a little crazy, but that's the rules. So an example, if your fourth quarter 2019 revenue was $1 million and your fourth quarter 2020 revenue was $799,000, that's a 79.9% revenue compared to 19. It doesn't qualify you for a 2020 credit because it's not below the 50%. But it does qualify you for the first quarter of 2021 because it's below 80% and you're allowed to look back one quarter. So let's look at another example of it looking ahead instead of looking backwards. First quarter of 2019, you have $1 million in revenue. Same quarter in 2021, you have $750,000 in revenue. So that's a 75% revenue compared to the prior year. That's under the 80%, so it qualifies you for the first quarter of 2021. But because you qualified for revenue for the first quarter 2021, you can use that to automatically qualify for the second quarter of 2021, even if your actual revenue for the second quarter is over that 80% limit. So that's pretty powerful. Okay, so we have some tax planning opportunities here, especially if you're a cash basis taxpayer. That's one of the things that we wanted to stress during this, is that if you are cash basis, you have a really big opportunity in order to manage your cash flow in order to get qualified for the ERTC. So you might be wondering, how would you do that? So you could consider delaying your billing as far into the third quarter as possible. That way your collections wouldn't actually come until they were in the fourth quarter. So looking back at the slide previously, if you qualify for that third quarter based on revenue, then it's automatically going to qualify you for the fourth quarter. So if you push collections into the fourth quarter out of the third quarter, even if your collections are far more in the fourth quarter than what you would qualify with this 80% limitation, you still would be able to get the credit for both quarters. So that could be huge. So we're looking at an example, $7,000 per employee per quarter. If it's 10 employees, that's $140,000. If it's 20 employees, that's $280,000. And if you happen to have 30 employees, that's $420,000. So this is huge. Definitely something worth looking at, and it's definitely worth the opportunity to manage your cash flow. We are saying that you need to do this the right way. You can't do it by sticking your checks in a drawer and not depositing them. So it really does have to be managed by the delay in billing. And now we're going to turn it over to Steve to talk about the PPP.
Needed to find that mute button. All right, I think I'm good. Okay, great. So thanks, Kelly. I'm going to talk about the PPP first, and then I'm going to go into the FAR. I feel like I've probably done this presentation about 10 times so far. So if you have any questions, because maybe I'm going too fast or I skipped over something, feel free to put it up into the Q&A section, and we'll try to get to that before the end of the session. So anyway, what is a PPP loan? Well, this loan is created to help keep people employed, right? Big scare at the beginning of the COVID time, and the government put in place the CARES Act, gave companies the ability to take these loans out as long as they kept their people employed. So there were 2 rounds of this, right? April 2020 and then again in February 2021. First round was for companies with 500 or less employees, and you could take a loan up to $10 million. Second round was much smaller, and they reduced the size of the companies that were eligible down to 300 employees, and the loans were capped at $2 million. And next slide. So to apply for forgiveness, right, they have 3 different forms for the for-profit. So you got a 3508S. This is the simple form. This is the easiest, absolutely the easiest. So if you have a loan that's under $150,000, you just have to put in there what you spent on payroll. That's it. You just one line, drop it in, submit it. There's no need to provide any support or backup. It's just you certifying to the accuracy of the payroll spent. Then the next form is the 3508EZ form. There are some qualifications for this form. So to qualify, you have to be able to certify that there were no reductions in employees from January 1, 2020 through the end of the covered period, or the company was not able to operate during the covered period at the same level of activity as prior to February 15th because of government regulations and compliance. The other aspect in there is also any reduction in wages or salaries by more than 25%. So as long as you didn't reduce any salaries by more than 25%, then all you got to do is then be able to say yes to one of those 2 bullet points. If you can say, yeah, we didn't have any reductions in employees, you qualify for the EZ, or say, yeah, we couldn't operate during the covered period because of a shutdown, then you can qualify for the EZ form. And the beauty of the EZ form over the long form, the 3rd bullet point there, is You don't have to go through the exercise of doing FTE reduction calculations, and you don't have to evaluate any reduction in wages. It's much simpler. Otherwise, you got to go through and pull data down from comparative periods in 2019, February 15th through June 30th, do your FTE calcs. Also look at the first 2 months of 2020, do the same calculation, and then compare that to what you had during your covered period. Next slide, please. So through the forgiveness process, there's some complexity to this. Wages, of course, are capped at $100,000 annualized. So you have a 24-week period. You got to cap that as if they were only able to earn $100,000. That comes out to $46,000 and some odd dollars. But for owners that are over 5%, those owners are capped at 2.5 months of $100,000 salary, which is exactly the amount that was built into the original loan amount. So 2.5 months equates to $20,833. And that's only for the owners that are over 5%. Other payroll costs are also limited. Some other ones are also limited, depending on the type of company you are. So your health insurance is limited for S Corp owners that are over 2% shareholders and family members. Your 401k can be limited. So it's important to understand, if you're going to include those in your application, how important it is as to what type of organization you are and what those other limitations are. And like Kelly mentioned earlier, you can't use the same wages that were used on other COVID-related items like the ERTC and the COVID pay, the Family First, from the Family First Act. And then, of course, the beauty of it is any forgiveness received falls under the standard, the FAR standard 31.205-5. That's the credits clause. So for any firms that are doing government work where you're required to provide the government with a overhead rate, this will apply to you. Next slide. Okay, so steps that you got to go through to get your forgiveness, right? First things first, the ERTC, that, for 2021, you're looking at 70 cents on the dollar. Your PPP, of course, is $1 for $1. So you definitely want to get full forgiveness. But as Kelly mentioned, there's a strategic approach to this. We want to first look at ERTC, calculate that maximum benefit. Let's see what we can get out of that. Identify those wages for the ERTC that were during the covered period for the PPP. Then we got to evaluate by employee total eligible wages for the PPP. Subtract out the ERTC and any FFRCA credit to COVID pay. If we can't get full forgiveness after we reduce the ERTC, after we reduce by the ERTC, then we go after the other costs that are eligible. But we have to keep in mind FAR. If you have the FAR credit clause, you have to keep that in mind too. And then if full forgiveness still isn't obtained, you got to go back and you got to reduce your ERTC and go through steps 1 through 4 again. Next slide. Credit. Now, next is a polling question. So I guess you can launch that, but is your firm required to submit not a FAR compliant overhead in conjunction with any government projects you're doing? We're just trying to get an idea as to how many people on the call today are doing FAR work. Because this next section, of course, is going to be FAR related and how we apply the forgiveness and your ERTC credits to that. And how close are we to having that?
We have about 4% to go, so just a few more people to answer before I can go ahead and close and share the results to this poll.
Else around, it's almost split evenly as of now. 46% say yes, they do have it. So we got a half and half crowd. So I'll go through this next section so it's relevant. So here's the wording for the credits clause. Essentially, any rebate you receive from the government, you got to give it back if you used it to pay for costs that the government reimbursed you through as you build cost-plus contracts. And on to the next one. So what is a credit? Well, as we're talking today, there's the three items. We've already talked about them. All three are considered a credit under the credit clause and are used to pay as related to payroll or payroll taxes, and all of those are reimbursable by the government, so they fall under the credit clause. Next one. So what is required under FAR? So we reimburse the government for any credits received for the costs that were previously billed and not paid and paid for by these credits, the forgiveness and ERTC, which means we essentially have to reduce our indirect cost pool for any of these credits received, which effectively reduces the overhead rate. So then you have two choices under the credit clause, and that is you book a liability because you're going to reimburse the government, cut them a check, or you're going to lower your overhead rate, and it essentially results in a lower overhead rate for future billings to the client. Most DOTs are not accepting a refund. They're looking for that credit to be applied in the overhead rate. Next slide. So there's some strategy to this. So we want to use 24 weeks of payroll only for PPP. We want to use 24 weeks, maximize it. We want to evaluate all this labor, reduce it for the ERTC and any other we want to put in there credits for the COVID. Then we're going to allocate our labor between direct labor on commercial and private projects. That's what we really want to identify. That there we can avoid our credit with that labor. And then look at the credit. What do we have left? Is it palatable? Can we accept that credit, that reduced overhead rate? If not, we got to go back to the ERTC calculations and look at only using the direct labor within that pool of costs and no health insurance. So then we come back and we reevaluate the PPP forgiveness with the new ERTC and see what we have left and look at that pool of costs now that's left over of direct labor on commercial projects. Go ahead, next slide. So that's a whole lot of back and forth circular, and really if you could imagine what it looks like behind the scenes, it's very similar to this next slide. That is pretty much what my day looks like when we go through these calculations of forgiveness and the FAR credit and all of that. I've yet to lose an arm, so far so good. So that wraps up my side. So on to Kelly.
Thanks, Steve. We will be discussing the R&D development tax credit, but before we dive into the credit, we do have one more polling question. If you want to launch that, please. We just want to kind of get a feel to see who takes advantage of the credit. So does your firm claim the R&D tax credit for your project design work? I'll give you guys a minute to get that answered, and then we'll kind of dive into more what the credit is, what qualifies, and how this kind of all intermingles together.
Alrighty, we're at about 81%. Need about 3 or 4 more people to answer for us to move on. Alrighty, here we go. Here, Kelly, here's your audience.
Thanks. Just about kind of split evenly about who takes advantage and who doesn't. So who does the R&D credit apply to? The R&D credit applies to multiple businesses in a different variety of industries. You know, the typical manufacturers can take the credit, you know, pharmaceutical companies, but also, you know, software development and engineering architectural firms can potentially qualify for the credit. You know, some examples of qualifying activities include, but this is not an extensive or exclusive list. There's tons and tons more of qualifying activities, but you know, the design and development of solar power systems, the design of bridges and highways to meet, you know, specific structural and drainage requirements, the design of renewable energy infrastructures, the development of waste treatment and remediation processes or technologies, the design of foundations and earthwork for site conditions, energy efficiency designs, mechanical, electrical, plumbing designs. This is just to name a few of qualifying activities for the credit. So what is the R&D credit, and in the nitty-gritty of it? So the R&D credit is a credit for the development of an unfunded new or improved business component. The term unfunded means you must retain financial risk for the work product. Projects operating on a fixed fee, lump sum basis are considered projects that retain financial risk. Time and material projects that do not have a hard cap would not qualify for this. Research eligible for the credit is limited to research undertaken to discover information that is technological in nature and intended to be useful in the development of a new or improved business component. The research must relate to the elements of a process of experimentation for a functional purpose. It must relate to a new or improved function, performance, reliability, or quality. The research must satisfy the four-part test in order to qualify for the credit. It has to be technological in nature, involve a process of experimentation that eliminates an uncertainty for a new or improved business component. The research and development tax credit doesn't reward just successful projects. The credit also rewards projects that fail, so it's kind of a nice little bonus for a project that does not go the way it should have been. But what is that worth to you? The credit is worth, typically the gross credit is about 8% of your qualified expenditures. Qualified research expenses consist of in-house expenses for the taxpayers and research. So it's already money you already put out of your pocket. Your wages for employees engaging in the research activity, directly supervising and directly supporting the research activity. In addition, certain supplies and contracted research expenses could qualify for the credit. Potentially some cloud computing costs could qualify depending on the nature. So like I said a little bit ago, this is already dollars you spent. So you're kind of getting a little bit of a kickback for it by claiming the credit, getting some dollars back in your pocket. As a result of tax law changes over the past couple of years, the credit has become more appealing, to companies to be able to take because the credit became permanent in nature. There's no longer an A&P limitation for small and medium-sized companies, where typically before this act, you could have qualified, but then you weren't able to use it on the tax returns. So it was kind of pointless to go through the exercise of generating a credit. But now, that limitation's gone. So this has allowed a lot more companies to be eligible for it. Not only are you allowed to take a credit on your current tax return, you are allowed to amend previous tax returns to claim the credit. And the credit, can carry forward 20 years for any amounts that you don't use, which gives you a really great planning opportunity. Year end, if you have credit carry forwards with cash out, what you need to pay, what you don't, and those type of activities. And also, there are a lot of state tax credits available too in the R&D arena that, some piggyback off the federal, so they're kind of an added bonus as well. Over the past couple of years, and especially I think within the past year, there has been a consistent bipartisan support for the R&D credit. There's been several proposals that were introduced in 2020, and we're expecting to see continued bipartisan support for the R&D credit. Everybody is kind of rallying around trying to keep innovation and development in the United States, keeping the production and different activities in the U.S., just because we've seen with supply chain issues and various things over the past 18 months, really trying to spur keeping things here. One of the enhancements came in the form of the FORWARD Act. FORWARD stands for Furthering Our Recovery with American Research and Development. The FORWARD Act is looking to provide some relief in the way of enhanced R&D credits, while also looking to potentially increase qualifiable R&D expenses. Some highlights we wanted to point out is, you can see on the slide, is higher credits for small and medium-sized businesses, expanded credits for startup firms, and an overall higher credit rate. There was another act called the Energy Act of 2020, specifically in Title III of the Energy Act. It put an emphasis on the renewable energy research and development, national resource provisions and energy storage. We're looking at advancements in water power research and development, geothermal innovation, wind and solar energy research and development. We're seeing an expansion of renewable energy related tax credits in conjunction with the research and development tax credit. As a whole in its current state, the U.S. Is supporting research development just because right now it's too low and needs to be increased. So from that side, you can see, there's been a lot of support in keeping this going. But then what does that mean? Kind of the interaction with, today's rest of the webinar, each COVID-related act leave is impacted, and R&D credit is impacted by that as well. It's kind of a juggling game. Like Steve mentioned, for the credits, if you take your OTC, how does that interact with R&D? We have to be strategic about the wages that are used, whose wages are we going to use, how much time will be utilized for that, so that we can maximize all around. And so it's definitely a juggling act, but it is a good opportunity to work together to maximize on all benefits because they are all eligible together. And now we're going to go off to Karen to talk about some of the state tax issues.
Thank you, Kelly. Appreciate that. And good afternoon, everyone. I know everybody loves talking about state taxes, but this is just another little wrench to throw in the works in regards to everything else that firms are dealing with these days. And I think one of the hottest topics on the forefront of A&E firms is the telecommuting and the remote workforce issues. And what comes about with these remote workforce and telecommuting employees brings on an onslaught of a lot of state tax implications. The first and foremost would be your payroll taxes. When you do have an employee that is working in another state, obviously you're going to have the payroll tax issue. And whether those wages are subject to income taxes or not, or withholding. It's nice that your employee calls you up because you're a great employee and they start saying now, I'd like to work in Hawaii. So what does that do to the company? Well, when you do have an employee in a specific state, that triggers a lot of taxes on the state side of things. As mentioned here, state income tax. It can trigger sales tax if you have any services or items that are subject to sales tax, as well as other state taxes, including franchise or property tax when you're providing that employee with computer equipment or anything else located in those states. So that is a big topic. And when it comes to the year end, or even currently, while you're looking at some of these issues and considering a telecommuting and remote workforce, you definitely need to do some planning and consider the impact to the business in regards to those discussions with employees, as well as also putting in some maybe remote and telecommuting policies. Understanding is the most beneficial way of heading off any type of unwarranted tax liabilities, and knowing where your employees are and being able to track those employees for payroll tax purposes and other tax purposes is a great advantage. And also looking at the cost benefit versus the talent pool that's out there right now. So when you're looking at this, definitely consider going into year end, do I have any new state filing requirements due to my remote workforce? And how do we need to address those? And what am I looking at liability wise? Now, there were some COVID-19 relief orders that were out, but most of those have expired. And as indicated on this map, this triggers your payroll withholding for a telecommuting employee. This is how long an employee can be in a specific state before withholding and payroll liabilities can be triggered. Now, a couple of the states are already updating some of theirs. Hawaii was pretty friendly. You could have someone there for 30 days. They have changed their rules now to a 60-day period of time that you could stay in Hawaii and work and not be subject to a payroll withholding requirement. Louisiana, they went from a 1 day, being in our state for 1 day, now allowing you to be there 25 days before a withholding threshold kicks in. The next map that we show is how long can an employee, be in the state before it creates an income tax nexus? And as you can see, a majority of the states are purple, and that indicates that 1 to 6 employees can create income tax nexus in those states. So this is something just to be aware of as you head into year end and as you plan going forward into having whether a permanent or a hybrid type remote workforce going into the future, and the impact that the state has on that. So the next topic that we want to talk about is this new thing that all the states are jumping on the bandwagon about, and these really apply to S corporations, partnerships, our so-called pass-through entities. And what these are elections where state taxes can be now paid at the entity level. With S corporations and partnerships, generally income from those entities flow through down to the individual shareholders and members. This was really kind of built around certain states because of the state and local tax limitation on individuals' itemized deductions. And you may have heard the terminology, the SALT cap workaround. That's the buzzwords in every news program you may hear or out in magazines and things like that. But basically what that is, it is a workaround where before you used to get some of those deductions when you pay tax at your individual level on your Schedule A itemized deduction worksheet. And now, because there's a limit, you're not receiving a benefit from those deductions. So the states are now jumping on this bandwagon to do these workarounds. Now, it's very attractive on the surface, but when you get down into the details of some of these, it's very, it may be beneficial for some shareholders and not for some others. Also may be more costly in taxes versus the flow-through tax liabilities. So it's something that you really need to consider. A lot of these have effective due dates, effective election dates in 2021 or 2022, depending on each state. And what you really need to consider when looking at this, if you are a pass-through entity, is definitely look at this and see if this can be a great planning opportunity and can really save your members and shareholders some tax money. Now, it may be beneficial for some and not for other shareholders or members of the organization, but it's something to consider and definitely look at it coming into year end and seeing if this is a viable option to help your owners reduce some of their tax liabilities. And lastly, as Kelly and Steve alluded to, a lot of coordination regarding PPP loan forgiveness and ERTC. And just to throw in another chainsaw, referring to Steve's juggling act, is the state considerations. For federal purposes, obviously they've mentioned that you do not have to include that as taxable income, and any expenses that were paid for by the use of the PPP loan proceeds are still deductible. Now, in some states, as you can see here, and just remember, the states have been very slow in issuing guidance here, and some of this may still change. But the proceeds, if you did get a PPP loan and that was forgiven, as you can see here, it's taxable in Minnesota. Those proceeds are taxable. In regards to PPP loan forgiveness, certain states are either limiting or not allowing any deduction in regards to expenses. So if you did get a PPP loan and you're located in the state of North Carolina, certainly it's not taxable for federal purposes, but the deductions are not allowable for North Carolina. So while you may have $1 million of expenses excluded and not taxable on your federal return, you're going to have $1 million added back on your North Carolina taxable income. So keep that in mind also. When you're doing your planning at year end or you're looking at these numbers overall, please don't forget to consider the state side of things and the impact. And again, all states are different. As you can see here, there's no guidance in regards to a number of states. As I mentioned, that's slow coming forth, but hopefully they will be passing some information along soon. In regards to ERTC, as Kelly mentioned, and so did Steve, that those wages are not deductible for federal tax purposes. So how does that play out on the state side of things? Well, there's terminology between a rolling conformity state and a fixed date conformity state. Rolling conformity states will generally follow federal law on that. And the most conservative approach is our suggestion at this time, without clarification on this from all state taxing authorities is that I would not deduct the wages either for state purposes until further legislation comes along, either decoupling from federal law or specifying a fixed date following federal law. Other than that, that's all I have on the state side. So I'm going to pass it over to you, Jen.
Thanks, Karen. So we've thrown a great deal of information your way over the last 45 minutes, and I just wanted to pull everything together. So basically, we've given you 1,000 or 5,000 piece jigsaw puzzle, and at this point, we're saying have at it. Go ahead and be that juggler that Steve referenced in his slides. You know, try to juggle everything. Well, actually, that's what we're here for. There's so many different things and so many different pieces of this puzzle that we need to pull them together and make sure that you are looking holistically at your entire situation from a tax standpoint as well as a business standpoint and making the right decisions. So, like I just mentioned, all of these topics are related. I think we've managed to present everything in a manner to realize this. My favorite saying is, don't let the tax tail wag the dog. So by that statement, I mean, you know, we can plan in a vacuum, and we can look in a vacuum at just pure tax planning at year end. Just how do we drive taxable income down to the lowest possible level and, you know, get that taxable income down to zero or wherever we want it to be. But if we don't look around and look at the entire picture, you know, we might be hurting ourselves in other areas where, yeah, you might be getting your taxable income down to zero, but you've affected your FAR overhead rate. You've affected your ERTC or your research and development tax credit. There's so many different things to consider when you're pulling all of this together for this planning process that really, in my opinion, also should not be just a one-time planning conversation in December. It should really be starting now and ongoing throughout the rest of the year to make sure that you're identifying everything that you can apply and pull together to create the best situation possible. So, and our suggestion then would be to be served by a team who will work together. So within our group, we're all working together to pull all of these ideas together. And next slide, please. We typically would recommend considering a quarterback to manage that relationship. So you have one person who really knows everything that's going on and is conducting regular and frequent meetings to understand just what's going on in general in the business, not beside, you know, not just all of these extra things, just, hey, what's going on a normal day-to-day basis. That way we know from here until year end, what do we need to focus upon here and what do we need to do to pull all of this together? That way this one person can coordinate the team, make sure that, you know, if information is requested by one part of the team and then another part of the team needs that same information, you're not being asked 7 times to provide the same information. So it really helps to have this team of professionals led by one group, one quarterback who handles all of the day-to-day operations of what's going on with your situation. So once we have that, you know, we can always, like I said, don't let the tax tail wag the dog, but we can throw in other pieces of tax planning opportunities. Once we see, yes, you can qualify for the ERTC, you can qualify for the research and development tax credit, and yeah, maybe your R&D credit might be lower this year, but that's setting you up for better years in the future with base periods. We can look to Section 179D, which is energy efficiency credits, or deductions. We can look at those and say, you know, we don't need to look at every single energy efficient project that you're working on, we can just look at a couple then at year end and say, do we want to pull just a couple of these in to get our taxable income to where we need it to be? We can also look at cost segregation studies. Those are other planning opportunities. Compensation and benefits and accounting method changes. You know, most people have switched to cash who can, but there's still opportunities to switch to cash basis of accounting for those who are still on the accrual basis. The other thing that we would most definitely be talking about from here until eternity are preparing for regulatory changes. You know, we had quite a few of those last year, and it goes without saying we think we're going to have quite a few more this year by the end of the year. We see higher tax rates on the horizon. We don't quite know yet exactly how that's going to play out, what rates exactly will go up, and how certain taxes will be affected. You know, the stories change every day. I haven't seen much on it lately, but we do know that that is on the horizon. So we would always be looking, are you using the best taxable entity? Are you managing your taxes in the appropriate way with everything else that's out there as well? And then the final thing that we like to make sure that we, you know, are talking about are these trends that we see. You know, demographics. We have a very large portion of our population who is looking to get out of their businesses, to change, to transition their businesses. So are we getting that in focus, getting things prepared for that? That's where we all come together again, this team of people, to make sure that we have all of our ducks in a row there. From a business transition standpoint, or just a general business standpoint, we like to look at leadership training, maybe for that future generation, project management training, financial training, and just looking at your firm infrastructure. So that's the benefit of having this large team of people who we can pull together and be looking at all of these items. So obviously it's a big puzzle, and there's a lot of pieces to pull together, but with a team of people like the professionals we have here, we are able to help guide through that process and make it pretty easy and keep you from getting burned like Steve Snyder mentioned in his portion. So with that, I'm going to turn it back over to you, Tom.
Thanks, Jen, and thank you, everyone, for joining us here today. I hope this has been helpful to all of you. See, my camera's not, there we go. A little trouble getting the camera to come back on there for a second, but we really appreciate everyone giving an hour of their time here today to hear these topics. We just think they're very important. We know we've repeated them in the past, but we just think that we don't want anyone to overlook benefits that are out there for them. We often hear people say, oh, I don't think that applies to me, whether that's the research and development tax credit or whether that's the employee retention tax credit. And sometimes that's just that they haven't, you know, really heard the whole story or the most recent story on the credit. So we want to continue to get that message out to you, but we also want to give you that alert that everything is interrelated, and you can really trip up if you don't look at the whole picture. So as Jen said, we think you are really served well by having a team with a good quarterback, as she described it, pulling all the pieces together and getting you the best bang for the buck. So again, we appreciate you being here with us. As we said before, if you have questions, if you haven't already submitted them, you can add them onto your survey. When you complete that, I do want to give a shout out to someone who you haven't seen on the screen here today, but you've seen many times before, and that's Christy Weierbach. Christy has been part of the team for this webinar too, and she's been working hard behind the scenes to answer questions as we go through things here today. But any questions we haven't already answered, you will be getting an email with those responses in it. The final slides in our presentation here today is a slide with everyone's contact information on it. So please do not hesitate at any time to reach out to any of us, and we will get back to you promptly and get you along the right track. So with that, again, thank you very much for your time today, and we look forward to talking to you again soon. Bye now.